Welcome to the Cyber Business Podcast, where we feature top founders and entrepreneurs and share their inspiring stories. Now, let's get started with the show.
Matthew Connor here, host of the Cyber Business Podcast, where we feature successful business leaders, authors, top law firms, green energy companies, and more. Today, we're joined by the managing partner of Watchhorn Risk and Wealth Management Corp and the co-author of Financial Blind Spots, Eric Watchhorn. Eric, welcome to the show.
Hi, Matthew. Thanks for having me. Nice to meet you.
My pleasure. Before we get too far in, a quick word from our sponsors. This episode is brought to you by cyberlinks.com. That's cyberlynx.com. Do you know if a hacker's in your system? Most people and most companies don't until it's too late and the hacker's already done damage. A hacker's job is to bypass your security, so companies need a way of knowing when someone's gotten past their security. That's where CyberLink's intrusion detection comes in. With our 24/7 Security Operations Center, we use a combination of AI and cybersecurity technicians to see when a hacker successfully bypassed your security. So if a bad guy gets past your security, we'll know right away and be able to kick them out. Find out more at cyberlinks.com. That's cyberlynx.com. And now back to our show. Eric, congratulations on your new book, Financial Blind Spots. Absolutely fantastic. Loved it. Great read. Tons of great information. For those who have yet to get a copy of your book, can you give us kind of the elevator pitch, the what inspired it, who's it for?
Thank you. Yeah, in a nutshell, we felt, Michael and I, we felt that there was a lot of blind spots out there. There was a lot of variables in finance, for personal finance speaking right now, that were not obvious to people. People were making decisions based on certain programming. We talk about it in the book, where that programming may come from. A lot of us are influenced by commercials, maybe some social media, maybe what our parents have said. Very limited from school, as you know. And we decided we'd write a book about that, basically. And we'd start where these blind spots really originate, which is, of course, our minds and our programming, and then how to maybe approach it with action, and then what the tools may be. It's kind of the idea of it.
Love it. So let's go through some of these blind spots. What are some examples that people might relate to?
Yeah, thank you. So the first part of the book, we've decided to make it part one, focusing on those very blind spots. Part two was spotlight. So getting back to the blind spots, the first one we kind of really concluded was your mindset. We don't know where the thoughts that we have may come from necessarily all the time. So to examine our own thinking is really, really critical. And basically that helps you identify if it's a blind spot or not. Sometimes we don't know what we don't know. Then we go into basically examining our mindset a little bit more. You know, when we examine and have a look at ourselves, we see that we have biases and tendencies, and we don't know necessarily if those are really logical or if they're not. So we talk about that, and then we look at, okay, now that I figured that out, why am I not acting? So procrastination is a natural thing. We all suffer from it. To whatever extent, but we don't try to isolate it as a negative thing. We see it as a normal part of decision making. So let's stop beating ourselves up about it and examine that as well and go forward. So that's kind of one other blind spot. And then we kind of move from those three sort of psychological aspects into the realization that we do live in a wonderful, evolved society. I mean, democracies, capitalism is all imperfect. We know that. But we have the ability to make decisions, especially in the Western world, and create our own universe. And so we talk about a silly little example about a couple of guys on an island, and how one guy decided to really utilize his creativity, his imagination, and invest in himself, and what the difference that came from that. And it's not an original story by us, obviously. We reference it in this chapter, but we really felt that that chapter was something that would inspire somebody no matter what their current environment is, whether the economy is up or down, or what your inheritance may be or not be, or even your education. I think that was sort of an inspiring element that we felt was interesting to put into the blind spot chapters, because, you know, once we figure out ourselves it becomes very important to also figure out, okay, how do I relate to my current environment and how can I make the most of that? And I think that chapter really helps that. Then we move on to maximum potential. So we get a little bit more pragmatic with this chapter. We go, okay, well, if I'm making all the right decisions and I can live for free, how much money can I actually even make? So we kind of look at the maximum potential and then we look at that big number and then we take things off of that, like taxes, costs of living, things like that. And it becomes a very realistic sort of picture that a lot of people don't spend a lot of time kind of examining as a starting point. I remember listening to coaches who say that, you want to have a GPS, you want to know where to go, but it's good to know kind of where you're starting, right? So this kind of leads into that a little bit. And then we get into the other expenses, or I should say blind spots relating to expenses, which are taxes. That's the biggest blind spot. And we talk in that chapter about the fact that most people, especially with this bull market in real estate and the stocks since 2009, this has been the longest bull market in history for most asset classes. We think that the rate of return is the biggest sort of thing to conquer, to the biggest solution to all your financial ails. And in this chapter, when we talk about taxes, we show that even though we may have an amazing rate of return, if we're not tax smart, it's going to kind of go to the wayside as well.
Mm-hmm.
And then we talk about opportunity cost and financing, which is, of course, in all our lives. And life is a venture. So if you look at yourself as an independent business person, even if you're an employee for the government, you can still look at yourself in that way. You kind of tend to make decisions in a little bit better way, financially and otherwise too. We get then into why strategy is important. Strategy is, of course, a huge thing. And we talk about it in finance and how to build your own team as well. Have a bunch of trusted people around you. So those are roughly the basics of the blind spots. And they're not all there are in finance. I mean, excuse me, it depends on what area of finance you really look at because there's so many facets of it. But these are the personal blind spots that we felt was a great starting point for most people.
Yeah, I mean, I think those are 10 just fantastic blind spots. And I think that a lot of people don't take much time to really examine, many, if any of those. So I think it's great that you kind of point those out. And, I'd like to dive a little bit further into kind of the mindset. I think that's one that it's your number one. You kick off with it for a reason, I think. So if we could just kind of dive in there a little bit and talk about the mindset that a lot of people, may have and kind of things to look for in your mindset blind spot, if you will.
Yeah, sure. Well, with the mindset, we talk about your birthplace and what advantages we may come into this world with. I mean, the statistics are rough out there, and I don't think we've referenced this in the book, but I think there's an 18% chance of us being born in a middle class home in the Western world with all these societal tools that we have around us. So we're already advantaged being born here. But what kind of household you grow up in, what kind of family and all that is your basic starting point. And some people basically are already on third base, so to speak. Some people are on the first. But your mindset really kind of can even the playing field. If we know the way we're thinking and we can be objective about where we are mentally with regard to especially money, and we can go from a lack point of view and mentality to a prosperous point of view, which most people that I've spoken to, they've been on both sides of the spectrum. We feel that is one of the most important things to start this with. Does that kind of address what you were hoping to?
It does, and I think mindset is so very important. And it, on the one hand, if if you're starting from the parking lot and you're not even in the you're not even on the field yet, right?
Yeah.
And you grew up with a bunch of people in the parking lot, to take that kind of baseball analogy there. First of all, they don't really understand the game much. They don't know people who played, who are successful at playing the game. They're still in the parking lot with all the other people, some of them who just tailgate all the time, some of them struggling to get tickets in, some of the people, so we're really getting our money's worth on this analogy, aren't we? I think but I think the proximity to wealth is so important. If you grow up and that's in your mindset, all you've ever seen is, the people around you never making it to second base, let alone, home run after home run. It's an entirely different scenario. So how does one go about, one identifying that, hey, wait a second, I don't have to, just be in the parking lot. I can be in the game. I can get, onto base. And I can advance. How do you combat that? Not that I think a lot of our listeners are, or people who watch this are are kind of those people. I think most of our audience is probably relatively successful
Oh, yeah.
people who've made it, second, third, fourth, made it home and multiple times. But I think even when you're successful at the game, realizing that it's always just a mindset, and how do you that it is limiting you. You could be getting around the bases faster. You could be going grand slam after grand slam, instead of just, base hit all the time. So how do you work on that mindset? Is it simply a matter of identifying that you have this limiting mindset, or what's your take?
That's a good question. I think, yeah, definitely the first step is identifying where the issues are or may be in your mind, and really kind of trying to take a close look at it. Sometimes that's harder than not. Yet talking to somebody that you have a financial relationship with would be a great start, I think. Um, the second thing is, I mean, one of the inspirations for the book was both Mike and I felt that despite the amount of financial information that's out there, people's retirement portfolios and the retirement statistics are not as good as they should be. We talk about that in the introduction from that Financial Post article, Kelly Keane, and they're actually quite dismal. And why is that? And if you look at the statistics of how many people out of 100 at age 65 are not where they imagine they would be, and many of those people could be professionals, could be business owners. And what you see with a lot of people is you have this bell curve of success. Something may happen along the way where it doesn't quite go their way, and it takes them totally off track, and psychological factors that are not positive take over. So we looked at that, and I thought, okay, well, people don't. One analogy I heard years ago was that imagine you're in a gym and you've got those ropes that you climb up, and they have these knots, right? When you climb up and you start to slide, there's those knots that prevent you from sliding all the way. If we don't have that awareness of ourselves financially in our mindset, we don't have those knots to prevent us from sliding all the way back down to that floor. And so we felt that we wanted to put some structure in on that. How do you get there? Really, it is really just by putting one step in front of the other. One of the things that we really talk about through the entire book is facets of risk. So we talk about physical risks, which are dealt with insurance, and insurance exists because we're in a civilized society, which has got hundreds of years of history. But then we also talk about risk when it comes to the markets. And people are always in a tug of war between fear and greed. So the more successful people in our audience would probably say, well, some of those basic elements I don't have an issue with, but I do have an issue with fear and greed on the more advanced side of things, if you will. Those ones, I mean, that's why the top traders and hedge fund managers will perform very well for a period of time. And then those rating services like Morningstar will show them at the bottom a few years later. Why does that happen? It's not because they've got some categorical deep issues about money. It's just because of fear and greed issues take over, and they're not as logical as they were when they were performing at their highest. So what we try to do with personal finance for the everyday person, we kind of try to deal with those things one little step at a time.
I like that. So, I can't help but think when you talk about, retirement, and I know we focus more on the financial side of things, but I'm curious. I mean, when you're doing this sort of long-term strategic planning, where do you place, kind of health? I mean, my wife and I are always, talking about that. Kind of part of our retirement plan is our personal health, right? I mean, you will need later on, is going to vary greatly depending on how you are physically, right? So if you're going into it in a poor physical state, and it's funny because we just came back from this a drive to Michigan, and just seeing other parts of the country and how the population as a whole it is wild when you kind of get outside of your little bubble and you see other, that I think statistically we're not in a great place in this country when it comes to health. And I think that drastically changes your retirement outcome. So I'm kind of curious as a professional who I'm sure stays awake at night thinking about all these things. Well, what's your take on that?
Well, you're right. I mean, health as well, right? And if you don't have it, then you've got it's just a compounding effect with your finances because people that have done very well, excuse me, and they get cancer, for example, excuse me. And they have to take time off work. If they don't have basic insurance through employer or their own plan, they're going to be pulling money out of the retirement funds. And that's really going to really affect the retirement picture down the road because the lost opportunity of that same capital in that fund is almost gone. Plus, whatever you pull out, you're probably going to get taxed on roughly 30% of withholding tax. And that's the same in Canada as it is in the United States. So it's a major, major hit. It's a compounding hit. If you needed 100 grand out of your retirement fund, it's going to cost you 30 grand right away in tax, and you've got 70, and now you've got that lack of 100 grand working for you. What can you do about it? Number one, obviously, we always try to stay as healthy as possible. But if you can think of it this way, is that life has got a starting point and it's got an end point, right? And we try to make it as long as possible, obviously, and in our best health. What comes with that is finances. People that do well financially generally tend to live longer. Why? Because they've got less stress. So the earlier you start on a plan, because time is our most precious commodity, just start saving as early as possible. The statistics are out there. You start saving at age 20 versus 35, you can save a lot less and be a lot more successful by just starting earlier. So I would do that, but I would also add a layer of insurance and protection on it because insurance and protection comes in play because it's a lot cheaper. It's easier to qualify because you're healthy. The risk is low. The insurance companies will take you on. And now you've got something programmed, if you will, that can be finite in terms of payment options, but permanent in terms of benefit options for you and your family. And that's what I would do. Because there's, in Canada, we have a structure that allows you to buy critical illness insurance with a full return of premium, corporately or personally. So you could set it up that if you were healthy and you never needed it, it's a forced savings plan. But if you needed it, it would give you a multiple of what you put into it. And the fact is that when we die, before we die, for most people, the wheels come off health-wise. And you will have a period of time, whether it's 5 years or 10 years, that you're dealing with something. Those finances can help a lot. And if you don't have to touch a retirement nest egg, and it's going to be another 10, 15 years before you retire, so that thing can grow, that's the wisest approach I would take.
Nice. I love it. So, you mentioned some of the biases that people have, and that's always a fun topic because I think that it goes, in a way, it is a blind spot, right? It's hard for people to see their own biases. Can you talk to us a little bit about biases and how that affects your finances, your investing strategies, or lack thereof?
Yeah, sure. That's a great question. So when it comes to biases, one of the things I've heard a lot was all debt is bad, right? And there's some people that promote just get out of debt 100%. And in general, I don't disagree with that. However, debt is in our picture for most of us on some level. Corporations are in debt, governments are in debt. So as individuals, maybe we shouldn't feel so guilty having all debt, right? But it's got to be a little debt and it's got to be wisely placed and it's got to be intelligent. And like Robert Kiyosaki would say, there's a difference between good and bad debt, right? If it's good debt, it's taken out for a purpose, for creating more revenues, where the revenues surpass the cost of the debt. So those are things that we would recommend too. Mike and I are not the kind of advisors that say, do this, this is good, and this over here is bad. When, it's very subjective, so for some companies, they want to acquire debt, other companies, it's not needed, etc. Same with the individual. Another bias or a tendency to be sort of leaning towards one side or another would be maybe insurance. I had that. So my career started in finance on a trading floor. I owned a trading floor and was co-owners and others internationally. We dealt with a lot of risk, and the clearing firm suggested I carry a lot of insurance on me, so I needed $6 million. So I had Tourette syndrome every single month when I was paying that premium, and I had a very negative
Nice.
attitude about insurance. I was not happy. The company was getting going. I was watching margins. It was one thing that I really wasn't totally convinced of, Anyway, as years went by, and I had a daughter, and within a week of us having our daughter, I was in a head-on collision. And just before you kind of pass out, and there was that moment when everything is slow motion, I was going, man, I'm glad I got that insurance policy. And here later on, I'm doing financial planning, and they're saying, hey, what about this insurance? Well, maybe I should get my course in that. And anyway, that's how that worked out. So I definitely had a bias there myself. And when I looked into it, the word insurance is such a general term. When you compare it to roof insurance, when the roof leaks and you got to argue about that kind of thing, it's a totally different thing than getting life insurance or car insurance. They're all different. But what I liked about the personal insurance, the more I dug into it, is it's very binary. When you're dead, it pays. When you're sick, it's pretty much identified by the doctor. It's third party, it's impartial. So those things are actually quite easy to work through. And when you do the mathematics of it, it makes a lot of sense. But again, earlier is better, healthier is better if you get that kind of stuff. Other tendencies, well, during this bull market, as I mentioned before, is everybody's used to major returns. And you would think that with all these major returns in real estate and in the markets, that we'd see a lot more prosperity. Not so much. And so why is that? So the leaning on, as long as I make 12% a year, everything's going to be rosy in my financial world, obviously doesn't apply. That the numbers show that. So I would say that the bias that is your main solution to your financial wherewithal, your financial world is a rate of return, that's a bias too.
Love it. So, just thinking about the second part of your book, on spotlights, and I think there's some really cool ones. One that I'm always intrigued by is the infinite banking.
Yes.
This, and I know it's not the quickest, easiest topic, and you could go on and on and on for a very long time, and at the end, people be like, really? But for I think the idea is kind of getting out there more now than it ever was. And can you kind of give us your kind of an overview and kind of your take on it, and how people can use that to their advantage in their financial planning?
Sure. Yeah. Infinite banking. Yeah, that's basically how Mike and I met. We were both practitioners of Bank on Yourself Canada, which is an infinite banking process. It's just another term. So there's many other terms that have been adopted by different professionals in the field. What it basically is, it's a concept. It's not a product, and it's based on a whole life insurance policy. And there's a couple of details surrounding that insurance policy. It's whole life, meaning that the company pays you dividends, and thereby it's called PAR, or participating policy issued policies. I refer to it personally as investment grade life insurance. It's a little simpler to understand, but it means the same thing. You do get a dividend. Those dividends are quite good in general. Each insurance company has a little bit of a different rate, but it's important to get that. And the other thing too is that one of the critical components of infinite banking is that you deal with an insurance company that's still mutual, that's not public. Although a lot of the benefits can be obtained by a public insurance company, some of the big ones like AIG or whatever, they may have a whole life product and they offer dividends, but maybe one that's mutually owned, basically owned by the policyholders, will have a better dividend. The other sort of potential benefit that would exist with that is, let's say 20 years go by and that mutual company gets bought up by a stock company that's owned on the stock exchange. The policy holders would also then get another sort of check basically for that process. And that's happened in the past with certain companies. But back to the infinite banking idea, what it basically is you put money into it, you get an immediate cash value, and you need to choose a policy with an advisor that understands the difference, where the cash value is strong in the beginning. Some other ones are designed more for an estate purpose, where the cash values really only show up after 5 years plus. The idea of the infinite banking is that you have it up front, and I like to refer to it as an efficiency scale. So the younger you are, the healthier you are, there's more efficiency, less risk, less cost of insurance. So if you put $100 in a month, maybe the efficiency is 50%, which means that the cash value portion would be $50 more every single month. If it's 75%, then it would be up to maybe $75 every month. There's always going to be a component that's the insurance piece, because if you died the following week, then there'd be an insurance payout to your family or your business, maybe. So that's the infinite banking. The idea is then to be able to access that cash value at will. And there's a few ways you can access cash value. You can kill the policy and get a cash surrender, basically. You can draw it out as cash, basically take a payment from it, but that's more taxable. Or you can take a loan against it. And one of the ways to maybe look at it is, imagine you have a house with $500,000 equity. You can go to the bank and maybe take $100,000 on a line of credit. That's basically what you're doing with a whole life policy and infinite banking. And the key things Mike and I would say on that is you got to watch, make sure that the tax side of it's properly done, so that you don't get charged interest on those withdrawals or those loans against it. The cool thing about it, we think, is, first of all, it's a life insurance product. The numbers really make sense. But the other thing is that you can actually use the capital in that. So on an RSP or a TFSA in Canada, if you pull money out, or 401k or Roth IRA, if you pull money out, that money stops doing the work for you. It doesn't grow anymore. With these cash values and these policies, is that you can take the loan. Yes, you're going to charge an interest like HELOC on a house, but the money will still grow in the policy simultaneously as if you hadn't touched any of it. So that's kind of cool. It's doing two columns at the same time. And we like it, but again, we choose to represent it in sort of a level-headed way rather than hype it up as this is the only way to make money.
So what would be an example of how you'd use that? I mean, let's say you had $500,000. You're looking to invest it in something. Where would infinite banking come into that equation?
That's a good question. The way we look at it is it would be another asset class. So it's a diversity tool, and it does a couple of things all at once. It'll give you the insurance protection you may need, plus it is another asset class, so it can balance out. So, for example, on the numbers here in Canada, in 2008, when the S&P did minus 33%, the whole life plan, the plan I ended up acquiring, did plus 7.9. So that's a nice diversity. That's a huge difference.
Yeah.
Yeah, and the volatility of it is minimal. It's that of a CD in the US or GIC. It's a little bit lesser actually. So it doesn't keep you up at night. So, and it performs better than bonds. It's liquid. It doesn't have to get locked in. And you can really kind of control it. You can take it out and you can pay it back. So those are wonderful things. We've seen its utilization corporately as well as personally in many, many different ways for different purposes.
Yeah, I was going to say I've heard of it being used in all kinds of very interesting ways that made me wonder, really? Is that possible? That sounds too good to be true. But you're saying that it can do a lot of interesting things. Now,
It can, yeah, very much. Yeah.
Now, is that dependent on you were saying earlier, getting with the right I guess, partner on that, right? Having, that understands what you're trying to do and supports it being, kind of accessed earlier versus later. And how do you even go about shopping that around and finding the right,
The
I
right
guess.
person to work with. Yeah.
Yeah.
So we're plugged in, even though we operate in Canada. Mike is in Alberta. I'm in British Columbia on the West Coast. We have a network of people in the United States that we could refer to. So if anybody wanted to contact us through the channels I'll share with you, we can definitely refer to them, somebody that really knows what they're doing. And that's the key thing, I think. It's like buying a mutual fund or an investment. Just deal with somebody that understands it. Yeah.
Yeah. I mean, I think most people have come, at least I would imagine most business professionals have come to appreciate the fact that it really is all about who you know and having the right partners. You have the
Yeah.
wrong one and forget about it. All your money and more can be gone. So finding that trusted partner is tough, and it's good to know that we have a resource there with you. So
Yeah,
love it.
we'd be happy. Yeah. Yeah.
Um, Fantastic. Looking at other spotlights, can you walk us through some that that are kind of you think maybe underappreciated, if you will?
Yeah, I think a couple things. Coming back to insurance,
Yeah.
as you know, I had Tourette's syndrome. Now I'm a big fan of insurance. Um, they're really underappreciated because the reality is stuff happens, right? And insurance, really, if we've done a lot of numbers on this. It's pennies on the dollar, whether it's
Yeah.
life insurance, whole infinite banking, whole life, that kind of thing, or if it's a critical illness or disability insurance, it's worth it. I mean, we all have car insurance, so what I would encourage people to do is look at it long term. We talk about this in there. Maybe it's worth mentioning is, for example, here in Canada, we've got car insurance and it's costing me, let's say, $100 a month to drive my car, right? And that's pretty much for life until I'm like 80 years old and somebody shakes their finger at me and says, you shouldn't be on the road, right? That's it. So that's roughly the picture I'm dealing with. But what if that insurance company said, Eric, instead of $100 a month for life, give me $300 a month, 3,600 a year instead of 1,200, but only for 20 years. And after those 20 years, you've got a side account of $72,000. Every penny you put in, you don't have to pay us any more premiums. You're covered for the rest of your life. Plus, that money's growing at 6% a year. Now it's more expensive, but it's better value, right?
Yeah.
So if you're dealing with a smart advisor who knows those things, okay, yes, you need protection, but can we give you protection in a way that really benefits you, where it's almost like it's a net zero cost? Those are the things that I think are important. And also when you're dealing with investment advisors, deal with people that understand the nature of the market. Like right now, we had all-time highs on the NASDAQ last week. If you've got $1 million of new money, would you all throw it in? I don't know. We're in the nosebleed, right? A 10%, 20% retracement would be extremely natural, and nobody would even be surprised because we've had such a strong run up. So you need to have awareness and objectivity with whatever you're doing, whether it's insurance or the markets. And I think that's really important. And we kind of break it down in those spotlights a little bit.
Yeah. I think it's really interesting because, when you talk about things like finding the right, insurance provider and partner, and earlier you were talking about taxes and how, that becomes such an important piece in, it can be kind of make or break. It can take all, it can
Yeah.
make a huge difference in your finances. And it's funny because I always think, people are quick to go to their CPA here in the States and do all of their tax planning and preparation with their CPA. And it always blows my mind that you get these very successful people who are using just a CPA. And that's kind of like going to the going to get medical care and only ever seeing a nurse. Like,
Yes.
why would you not go to the doctor, get your tax attorney to help you with the really big pieces, the strategy, and then have the nurse, help you with the details. And it's just amazing to me how many people miss that. I'm like, wow, you're just, and I take this and now anytime it's crazy how many very successful people I've talked to about this idea, and they're like, wait, really? Where they have just been using their CPA forever. They're like, oh, I love them. They're great. They're fantastic. You should use them. I'm like, are you crazy? I'd like, who's your tax attorney? It's kind of like you're playing, you get this very complicated board game, and there's a quick start guide. Now you can put, everybody reads the quick start guide, and you can use that.
Yeah.
Or you can take $200 from your initial amount and pay an expert who's read the 5,000 pages of the manual. Who's going to win that game? Is it everybody who's playing with the quick start guide, or you with that advisor who knows all of the
Yeah.
the rules? Obviously, you're going to win if you get that tax attorney on your side. So it always blows my mind that people don't spend the time and the effort to get that tax attorney, because it just makes a world of difference.
You know, to add to that, I found it always surprising, and Mike gave me a lot of understanding on this. Some accountants are debits and credits kind of guys. They're just there to handle your tax return. They do it well, but that's it. But they don't look maybe at your blind spot, so to speak, right? They don't look at, hey, you could be doing this or you could be doing that. And I understand your picture, but you should consider this, right? They don't go the extra mile. And sometimes we put so much trust in our accountants, but yet they're only fulfilling a very narrow role, right? Just like you say. And yet accountants are actually the most trusted professionals out there, according to some surveys.
Yeah. No,
Yeah.
I can see.
Yeah. Here's an interesting thing. We have it in the book another way, but I think it's worth sharing real quick, is the impact of taxes on your rate of return. So let's assume I was even better than Warren Buffett, right? I could create amazing returns, and I could do 100% a year for eternity, which obviously is not the case, just to be clear. But let's say that was a hypothetical scenario. And let's say I took $1 of yours and I doubled it every year by that 100%, right? So we're going to just do that example for 20 years. So year one is $2, right? 2, 4, and so on. How much money do you think we have after 20 years of that doubling?
Yeah, it's a huge number.
Yeah, right.
Yeah,
So it's about 1,048,000 roughly.
not bad for $1.
Not bad, right? 20 years. But this is a power of compound interest, right? And a massive rate of return, right? Also unrealistic. However, let's say I took 30% tax on that. This is the power of taxes. So $1 doubles, same rate of return as $2, but now 30% tax and now $1.70, right? And then that doubles. How much do I have after 20 years?
Yeah, what is it? It's about $250,000, something like that. What is it?
No, it's only around 50,000. That's a major hit, right? And what about 50% last week?
Oof.
Same idea.
What do you get? 10 grand?
5,400.
Wow.
So same rate of return, taxes. And the reason taxes are obviously, it really affects your compounding and your rate of return. But the reason we like insurance as an asset class, because it's still tax advantage. It's one of the last things the governments haven't hit so hard or at all.
So what I'm hearing you say is, don't pay taxes.
No. Pay your taxes. Absolutely. But just
kidding.
work within the confines and what you're allowed to do,
Yeah.
So definitely.
Yeah, no, it's just ridiculous how much that changes. And so,
Crazy. Yeah.
to your example, a real world example is if you're not using kind of the right advisors and you're paying here in the States, you can easily be in that, 40% tax bracket, or you could be paying, much closer to 10 or less, depending on how well you're set up.
Yeah.
It is not infrequent for people to be making a lot of money and not paying, much if any taxes, because you're using the tax code properly, instead of not using it all and paying, way more than you should be.
Yeah, exactly. And a lot of business people, especially when you start out, you become a small business person that's successful, making good money, you really don't have a lot of time to sometimes breathe or want to take the time off to think about money, because you're dealing with it all day long at work. Now you got to look at the big picture for your personal life. A lot of us kind of wait a little too long with that. So yeah, it's understandable, but it's important.
Love it.
Yeah.
So I tell you, I think we could do this all day and all night.
Yeah.
It's a fantastic topic. I Thank you for coming on. But before we go, can you tell everybody where they can find out more about you and your book and where they can get a copy?
Sure, thank you. It's on Amazon. It'll be at Barnes and Noble and in Chapters eventually in Canada as well. It was launched about 10 days ago. And the best way to get it is actually through our book website, which is financialblindspotsbook.com. And the email with it is info@financialblindspotsbook.com if you have any questions at all.
Fantastic. Well, Eric, thanks again for coming on the show.
Thank you, Matthew. Been a real pleasure.
Thanks for listening to the Cyber Business Podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.